Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Jack Forehand is a principal at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack sits down with Mutiny Fund's Jason Buck. Many investors, including us, are big believers in the idea of stocks for the long run. But the fact that we have that as a high conviction belief makes it important that we challenge it from time to time. Jason, along with his partner Taylor Pearson, had a really interesting recent episode of their Mutiny Fund podcast where they did exactly that, and we wanted to have Jason on to dig into it. Jack and Jason talk about why the experience of the US stock market is an outlier when compared to international markets, what the long-term returns of other global markets look like, and what it all means for investors. They also discuss constructing multi-asset portfolios, sustainable withdrawal rates, what investors can learn from sports, and a lot more. We hope you find Jason's insights as interesting and thought-provoking as we did. As always, thank you for listening. Please enjoy this discussion with Jason Buck.
Jason, thank you for coming back on.
It's a pleasure to be back on. I'm surprised you guys had me back on. I put people to sleep talking about options Greek last time.
Your other episode did really, really well. Like everybody loved it. It was really, we talked about, if people want to find it, we talked about to you about how you manage your personal portfolio on our Show Us Your Portfolio series. And yeah, it was really interesting. And we're going to get into a lot of the similar topics today to what we covered there. But what I wanted to start with today is I was listening to your Mutiny podcast, which is really, really good. And I would recommend anybody subscribe to it because it's great. But you were talking about stocks for the long run, this idea. And I'm one of these stocks for the long run guys. Like I'm the big believer in the stocks for the long run thing. And so I love challenging myself on that. And like, there was a lot of stuff in that podcast that challenges me on that. So I'm really excited to talk to you today about that and about how that carries to other countries and a lot of other ideas around that.
Great. No, I mean, that's a shout out to you for like being a stocks for the long run guy and wanting to find a disconfirming bias, right? Like most people are always looking for that confirmation bias. And I'd love to be a stock. It's really hard to argue against stocks for the long run because I feel like it's one of those scoreboard things. Like everybody just points to the last like 40, 50 years and it's like scoreboard. And you're like, you're the turd in the punch bowl at the parties, like pointing out what could potentially go wrong. So I understand why most people are stocks for the long run. And at a really high level, what I try to think about is, what can and could go wrong. And from a really high level, I think it really boils down to something very simple for me is that, a lot of times you'll see, these stock charts that just go up and to the right for the last like 150 years in the US specifically. And I go, okay, what happened in the last 150 years? Well, we had the full advent of like the Industrial Revolution, and we went from about 1 billion people in the workforce to 5 billion people in the workforce. And the US has been the most dominant country in the world for the last 150 years. And I'm like, does that play out into the future? And you just look at population growth and statistics, it's not very likely. So what I always question is this a 150-year period, and then more specifically the last 40-year period that we'll get into, are these likely to continue on into the future? What can I learn from the past, and can I project that into the future? And I'm always, uncertain of my own biases there.
Yeah, Adam Butler, who I know is a friend of yours, has had this quote he said on our podcast, which I think is really good, which is the past is only one sample draw in an infinite series of sample draws. And like that's stuck with me ever since he said it, because even these really, really long periods could have played out really differently than they did.
Yeah, exactly. I mean, I think about it all the time, even the sample draws of like even my brother and sister, they're twins and they're a year and a half younger than me. We grew up in the same household and we're all vastly different. Like those billions of epigenetic influences on a daily basis can start to lead to larger perturbations over a long enough time horizon. So you never really know. That's that one sample size.
So before we start, I want to talk about real versus nominal returns, because this is something you guys did in that podcast, which I think was really excellent. Because anytime in the financial media, anywhere, like all you see is nominal returns. You never see real returns anywhere. But real returns are really, really important. So I was wondering if you could talk about that. Why do you focus on real returns instead of nominal returns?
I mean, to me, it's really a basic thing. I always just think about what's my net that I can eat at the end of the day, right? And so most people always talk about nominal returns. The two things that drive me nuts, they talk about nominal returns, and they're usually just talking about your annual arithmetic return, like each year. And they don't think about the time horizon and that we have to actually compound those returns in real life. And then they're just looking at the nominal return prior to inflation, but that inflation over time can be a pernicious drag on your portfolio. So if it's average 3%, et cetera, you have to subtract that out from your nominal returns to get your real return. Because what you really think about is, I think the industry has led us wrong in talking about our savings as investment. And it takes, unusual risk then with our savings, because then we think this investment should really grow over time. But what we really want our savings to do is outpace inflation and be there when we need them most. And so that's why we have to really think about real returns, of taking your nominal return minus inflation gives you the real return. And maybe we'll get into it later, but people love to debate what the inflation number is. I don't know, I don't necessarily want to get in that debate, but over a longer time horizon, let's just say it averages about 3% a year. So if let's say the stock market was compounding at like 10%, you have to minus that 3% out of there. There's a little more math to it, but that gives you the rough heuristic of about a 7% compounded growth rate over the last 100 years plus.
So when you looked at the long-term real returns of the U.S. market, what did you find with that?
Yeah, so I think the rule of thumb I always like to use, because everybody unfortunately will use different bookends for their time horizons, right? Like you'll hear a 100-year return, and that's really like 1916 to 2016, or like or 1920 to 2020. And it's like everybody's using kind of different bookends, which gives you a little bit different numbers. But the easiest one to think about long term, I think Meb Faber's done great publications on this, and I think some of it comes from the Triumph of the Optimists. But over the long, whether you want to use 100 years, 120, 180 years that we'll talk about later, the idea is the real returns, the rough heuristic I use is stock market's about 6.5%. Let's call it 7%, because some of those windows will say 7%. So let's be optimistic. Let's say the real returns of the US stock market are 7%. The real returns of global developed stock markets are about 5%. Interestingly enough, the 60-40 portfolio over the really long term is about 5% real. Commodity trend followers do about 4% real compounded. Bonds 2%, and bills are about 0.5 to 1% over time. So that's the kind of rough heuristics we use. As I think about it as like 7, 5, 4, 2, 1 gives you a rough idea.
So inside of that global number, there's a big amount of dispersion with all these other countries. So like, what did you find when you looked at that? Because one of the things I've always wanted to say in a podcast is now do Japan. And so this is your opportunity to now do Japan.
Yeah. So what we were looking at is, there's a great book by Jeremy Siegel called Stocks for the Long Run that is one of the best-selling books of all times in finance and investing. And more recently, Arnarkulova et al. In the Journal of Financial Economics did kind of a takedown of that paper. Not necessarily takedown, but they want to look at like developed economies globally going from 1841 to 2019. So there's like a 180-year study of kind of global stock markets and thinking, about real returns over those global stock markets, or even nominal returns. It doesn't really matter. But like you're pointing out, the dispersion, in using 30-year rolling windows, 1990 to 2020 for Japan is negative 20%, 1% real return total. So you had a 30-year period of being underwater in Japan. And it's interesting, like you said, that's usually the anomaly that people point to. And I wonder, we like to throw it out there as an anomaly because people don't want to deal with it. Like you said, now do Japan, and people's brains kind of break because they're like, well, it just doesn't, you can't count Japan. I always wonder why or how that happened. I really don't know the answer, other than I really wonder if I'm being compassionate towards my MMT friends. I wonder if that's the first time we really had that developed economy have that underwater period, post going off the fixed rate exchanges. And so maybe Japan is the leader. Maybe some of these other developed countries are going to see something that's, similar to that in the future. But then you're talking about what is the actual dispersion of those returns. If we look across global stock markets on real returns over like 30-year rolling windows, like the first percentile is a negative 94% return. And the top percentile, that 99th percentile, is a 70x. That's a massive dispersion in returns that gets you to an average of 7% CAGR on real terms. So like that's the kind of dispersion we're talking about, from negative 94 all the way up to 70x. And then what they tout in the media is that your average is 7% CAGR. And we'll get to this. Is like, are you likely to be average? I'm not so certain of that.
Yeah, what's interesting about Japan too is Japan is a developed country. I mean, you can give Russia and all those examples all the time, and people will just say, well, what happened in Russia is never going to happen here. And they're right about that probably. But like, Japan is a legitimate developed country that has very, very different results than we did.
Yeah, and it's even better. Have you ever been to Japan?
No, I haven't. Have you?
But yeah, it's like, I mean, I still haven't been there too, but like everything you read about it and everybody I know is going to visit, it's an amazing country, right? It's very advanced. Like you said, it's a full economic, there's a lot of things people take from daily life that are better in Japan than they are here. So it's not like that negative 21% real return over 30 years has not necessarily destroyed the country. It's just what you've actually seen in their stock market, which we can get to another question of like, how real is that? But if that's our savings vehicle, it's very real to us. But like you're saying, it's not necessarily affecting the underlying economics of Japan as a country, or the actual daily life of the people involved there.
Yeah, this is the big challenge. You talked about this a little bit at the beginning, this idea of, is the US different? That's the question a lot of us have to ask, because how many countries were there with like better returns than the US? Probably Australia, maybe. Well, we were right at the top,
Yeah,
though, right?
you can. Yeah, it depends on, like, especially if you take more modern 30-day rolling windows. like you had Australia and Canada didn't really feel too much of the 2008, especially Australia. And then if you especially look at like their housing markets, it's insane over the last like 30 years because they didn't have that GFC, that 2007, 2008 collapse like we did. So yeah, but over the longer term, we're right at the top. Like I said, globally average is more about a 5% CAGR, and we're at about a 7% CAGR.
So can you come up with any reasons why the US should continue like in the next 100 years to be what it was in the past 100 years? I mean, if I just look at today and not over 100 years, and we've got the best companies here, you could argue we're the center of the free world. I think you pointed out in your podcast, we've got oceans around us. That certainly helps us. Like, how do you think about that? Is there anything in there that would justify like the US having this gap over the rest of the world like we did in the past?
Yeah, I think there's a lot of things, but I mean, I also want to point out, like you said, like let's do Japan. The other thing that a lot of people point out with like even 60/40 portfolios being underwater globally over like rolling 20-year windows too in real returns, like you see like even going back to 1990, you had Russia -100%, China -100%, Germany -100%. So it's not just Japan. And then the whole point is like, oh, people can go, okay, let's take out the First World War and Second World War because it's understanding how their economies or stock markets got destroyed. You have more modern versions, even like Italy, 1960, 1980, -72% on a 60/40 portfolio. Similarly with India, -66%, Spain, -59%. So it at least broadens us out to not think only Japan's the anomaly. Like this has happened kind of globally across developed markets. So what do we have American exceptionalism? Look, I'm born and raised in America. I've thankfully lived all over the world, but I mean, I'd love to believe in American exceptionalism, but I can't help the little voice in the back of my head going, we're not that special. If it can happen anywhere, it can also happen to us. And like you were referencing, you have, you read your Peter Zeihan, right? We're surrounded by two massive oceans. We have unbelievable two weather patterns that create this, breadbasket in the Midwest and upper Midwest. We have all these amazing things going for America and then obviously our innovation that we get out of Silicon Valley. And then now are we in a two-headed race on AI between the US and China, and Europe's kind of gone off of that race? We'll see. I mean, so there's a lot of reasons to be very strong and bullish the US. And I am, like I'm an optimistic entrepreneur in the US. So I'm very happy if the US continues to outperform. But just looking at a historical perspective or the context of the things we've been talking about, it's not very likely, or it's possible that we could experience drawdowns. And more importantly, we can experience, severe drawdowns. And then it's more the duration of the drawdown. Like how long is that going to happen? And relative to your lifetime. And we don't need to even be American exceptionalist to see like historically how many times the US stock market in real terms has been deeply underwater or had really negative returns for, 1 to 2 decades at a time. And that really can affect you if it lines up with your retirement or your peak earning years.
Do you know what the longest period of negative real returns was for the US? I mean, I know that there's this chart that always goes around where people love to do the nominal returns. So there's always like this idea, like over a
Yeah.
20-year period, 100% of the time, there's been positive nominal returns over 20-year periods. But I'm wondering like how, when you take that to the real world, like how that plays out.
Yeah, there's an argument between the 30s and 40s and then the 60s and 70s. And it's anywhere from 15 to 20 years being underwater in real returns. And that's whether it's, stock market and or 60/40 portfolio. But I mean, even on nominal terms, you've had, the Great Depression was a -83% drawdown in the stock market. And then even more recently, I think people forget from 2000 to 2013 in nominal terms, the stock market was underwater for 13 plus years, like 13 years and 4 months. And that's very recent history for us. And it had the peak drawdown was -60% just in nominal terms during that period. And then I think we can argue more recently how much inflation has fluctuated. So it's really hard to figure out. I think real returns, if you have to line up years, then doing, I think, an average over the last 20, especially when we talk about the US over the last 20 years.
I want to shift to how we think about building a portfolio in a world like this. If we assume like what's going on with the US is maybe not as likely in the future as it was in the past. And I want to lead into that with an article you wrote and I think you just read this for Meb Faber's podcast, if I'm correct. He has a new podcast where he's taken the best investment writing, and I think he's carved it out into a separate podcast. He used to do it on the Meb Faber show. But you wrote this article about this idea of Herschel Walker Syndrome. And I wonder if you could talk about what that is.
Yeah, and I think as I get into Herschel Walker, and this will relate, is the things we've been talking about. Like, even if the U.S. continues as it is, there's a dispersion of returns, right, that we have to really think about, and what is our individual path, and this will relate to Herschel Walker. But, we talked about, the first percentile and the 99th percentile, but even when I take the 25th percentile, you still have a 1 in 4 chance over 30-year rolling windows to only make a 82% total return, which is a 2% CAGR. I don't think Americans realize that. Like, if you have a 1 in 4 chance over a 30-year period for a 2% CAGR, I don't think we're thinking about that very often. And then as we were highlighting earlier, if we use global developed markets, you have a 1 in 10 chance of being negative over a 30-year window. And I just don't think people think about those dispersion of returns. And that's going to relate very simply to what we talk about later. But related to that is like, I'd like to put hard numbers on it. If you're in that 25th percentile, and let's say you're 35 and you want to retire at 65, that means you went from, in that 25th percentile, you went from 500,000 in savings to 910,000 in savings. That's not a lot over over your time horizon of peak earning years. Versus if you got the average, you would have went from 500,000 to 3.8 million. So that dispersion of returns makes very real when we think about our retirements and what's our income at retirement for those distributions, which I know we're going to probably talk about later.
I love the idea that you use the word savings all the time, because it's a great way to think about it. Like there's a safety in that, and thinking about your portfolio as savings versus thinking about it the way most people think about it. And I think it's really good, like for a lot of investors to maybe use that word instead of some of the other words, because they'll view their portfolio differently.
Yeah, I very specifically choose to use that word because that's actually what we're talking about. And especially I use it as a business owner and entrepreneur, and most of our clients are as well, is like, whatever you have left that you can't put back into your business is savings, right? And that's what we need to, to compound and be there when we need it most. So that's why I'd really try to harness on savings. Herschel Walker. So what's interesting is Herschel Walker was drafted to the Dallas Cowboys in 1985. And over his lifetime, Herschel Walker was a Hall of Fame player. He had over 8,000 rushing yards, 61 touchdowns, and almost 5,000 receiving yards at a time when running backs weren't receivers. So he was really a multi-tool player, a really diverse threat. And in 1989, the Minnesota Vikings decided they had to have Herschel Walker. That was going to be their missing piece to win a Super Bowl. And in that time, in 1989, I believe the Dallas Cowboys went 1-12. So Herschel Walker was by far their best player. So why would you get rid of your best player? They decided to do a trade with the Minnesota Vikings that eventually was 3 draft picks and an additional 5 players. So essentially 8 players for one Herschel Walker, for one great trade. What's interesting, actually, you can watch a documentary of this on 30 for 30, but actually the Jimmy Johnson and the Dallas Cowboys, they traded their way from like that 3 draft picks and 5 players. It ended up being like an 18-player trade when they got said and done with San Diego and everything else. I mean, it's just a crazy story overall. But in the end, Dallas Cowboys used all those draft picks to go out and get people like Emmitt Smith, Darren Woodson, and build a team approach. And over the 1990s, the Dallas Cowboys end up winning 3 Super Bowls in the early 90s, and that's how they became America's team. Meanwhile, Herschel Walker was kind of a bust for the Minnesota Vikings, got traded later to other teams. And so what we try to use this as an example of, the Minnesota Vikings were thinking about the one great trade, while the Dallas Cowboys were thinking about a team approach or the ensemble approach. And that's what helped them to win championships. And it was eventually called the Great Train Robbery because that's what Jimmy Johnson bragged to reporters, is that for one player, he ended up, parlaying that into 18 different trades. So it was the Great Train Robbery. And that's why it's known as both the Herschel Walker trade and the Great Train Robbery. And like I said, there's a great documentary on 30 for 30 about it on ESPN. But this is why we always like to think about an ensemble approach and a portfolio construction approach versus a singular trade. And I think most people think about their investings or savings as an singular trades, whether that's the S&P 500 index or if they're a stock picker, and they're not necessarily thinking about the portfolio construction of their team.
Yeah, I was thinking about that when you were saying it. I mean, those trades where you trade like the whole farm system or all the draft picks, like for one guy, they rarely work out. I mean, I guess the only time they work out is if you if you win the championship that year, because you could argue the odds of winning the championship are not that great. So like if they'd taken Herschel Walker and maybe they had won 2 championships, then you could say it was worth giving that up. But those trades seem to never work out.
But like to your point, I think that's basically what the LA Rams did, right? Like they were like, we are going to win a Super Bowl this year. So they went all out on that. But even then, they still had to get like 3 or 4 players to really build out their roster. And it was still because they had already great players on their team. So it wasn't necessarily all out on one player. It was all out to win the Super Bowl. And all out to win the Super Bowl means we need to build the best team that has the highest probability of winning the Super Bowl. So even in that case scenario, they still went with the team approach.
Yeah, that makes sense. I was also thinking when you were talking about that, about Eric Crittenden's a good friend of yours. Like his Dennis Rodman thing is like the opposite of your Herschel Walker thing. Like he always talks about Dennis Rodman as a great example of like how to build a portfolio, whereas Herschel Walker is like the example of maybe how not to.
Yeah, I think, and Eric, I think originally got that from Chris Cole that really popularized Dennis Rodman. And I was actually talking about that recently, and I was like, I'm going to talk to you about the greatest basketball player of all time from the Chicago Bulls. And everybody's like, Michael Jordan. I'm like, nope, Dennis Rodman. Because Dennis Rodman's the lowest scoring player ever to be in the Hall of Fame, but at his height, he was 6 standard deviations better than any other defensive rebounder in the league. And so he ranks number 1 for the highest efficiency of points differential percentage when he's in the game versus out of the game. Because if you think about it, he was able to garner, 17% of offensive rebounds, and he's kicking that back. to Michael Jordan, Scottie Pippen, Steve Kerr, or Paxson. And that's what's increasing the offensive efficiency of the team. But we always are enamored by these high scoring players like a Michael Jordan. And we're not thinking about the defense or the rebounding that helps us as the ensemble of the team to eventually win championships. Like, our moniker for our firm is offense wins game, but defense wins investing championships. And I think people really understand that in sports, and that's why I love sports analogies, but they tend to forget about it in their portfolios when they tend to hold all offensive assets. And when correlations go to one in a liquidity event, they all go down together.
Yeah, I kind of wish Robin played like in the world of like advanced metrics like we are today, because he probably would have made a lot more money, first of all, because now I think it's easier to understand what his value is probably than it was back then.
His daughter plays for the U.S. women's soccer team. She was just in the Olympics. She scored some gold in the Olympics. Yeah.
Oh, cool.
A lot of people don't know that. Yeah, that's it. That's his daughter on that team. But like you're saying, is like the Moneyball era is what I think is interesting that's come out of that is like coming out of the great train robbery, Herschel Walker trade we talked about. Then you have examples where, Billy Beane got famous with the Oakland A's. And then, part of that book that was written in the movie with Brad Pitt. But what people forget is Theo Epstein took those ideas to the Boston Red Sox, and I believe they won their first World Series in 85, 86 years. And the reason I bring up the Red Sox is because the owner of the Red Sox, John Henry, is a commodity trend follower, a guy that's really focused on statistics. So that's why he really believed in Moneyball. But he went on to buy Liverpool FC in England, so the British soccer team. And what they did, he bought it in 2010, but in 2015, they hired Jurgen Klopp, the coach from Germany. And he played what they called heavy metal football, was just all out attack, just beautiful game, just all out goals that score as many goals as possible. But for the first few years, they scored a lot of goals, but they had a lot of goals scored on them. So their win-loss percentage wasn't as great. But in 2018, they went out and got Alisson Becker from Brazil, which was arguably the best goalkeeper in the world. And they got Virgil van Dijk from Holland, who is with Netherlands, who is allegedly the best defender in the world. So they shored up that defense with that all-out attack. And then they went on to win the UEFA Champions League, and then they won the Premier League for the first time in 30 years. So it was just another example of the Moneyball approach, but more importantly, shoring up your defense so that way your offense can be a lot more aggressive.
I could probably spend the whole time on sports, but I think the listeners would probably not like that. So I probably should pivot back to investing. But I wanted to ask you the question I get all the time when we talk about, because we run a lot of these, more diversified than stocks and bonds, multi-asset portfolios. And the question you get all the time is, you gave me the real returns at the beginning. Stocks had the highest real returns of all the various things you talked about. Like, why shouldn't somebody who has a 30-year time frame, who's got the behavioral skills, to stick with it, why shouldn't they just own stocks? And that's a question you hear from individual investors all the time.
Yeah, it's a hard, like I said, it's going back to what we started about with scoreboard, right? People are looking at recency bias when they think about that. But also, like we said, if you look at the long history, you see it goes from the bottom left to the top right over the last 100, 150 years, especially in the US. But what people are missing if they zoom in is those underwater periods, right? If you have those underwater periods for 10, 20 years that we were talking about, or during your peak earning years or your retirement years when you're taking those distributions, it can be really detrimental and negative to your portfolio. So the way we like to think about it is this fancy word called ergodicity. But it's what we used to call sequencing risk, right? Is like your path is not that ensemble average path. So this is what I'm saying is not only does the industry tend to, lie to us and treat our investments, as something that we can get rich off of instead of talking about them as our savings. The other one is they talk about those averages and that's what we started talking about is like, is the average path what you're going to return? And that's why they're looking at 7% CAGR or 10% nominal that people started to affix to these days is like, are you likely to get the average in the future, or is that the average of all the players? So to think about ergodicity, the real simple version is you're an ergodic system when the ensemble average is equal to the path average over time. The key word being time. And so a lot of times when we think about expected value and things, we're not adding in the addition of time. And throughout our lives, we compound through time. And so a lot of times when your individual path does not line up with the average path of the ensemble, that's a non-ergodic system. And unfortunately, markets, savings, compounding are non-ergodic systems. And so if we treat them like they're ergodic systems, we're likely to fall for a lot of things that can be really detrimental for our portfolio. To put it like a finer example on it, I think a good example would be is if 100 people were going to the casino. Let's say 100 people are going to Caesar's Palace, and let's say I have a game plan where they can make 50% returns. So I give them each $1,000. 100 people go in this casino. They're expected to make 50% returns or $500, but let's say one out of the 100 is going to totally blow up. So their expected value is $1,495 per player, 400, plus 495. That's great unexpected value. So the 100 people go to Caesars, one blows up, but it doesn't affect any of the other ones. Let's say let's say player number 28 blows up, but 99 other players make, come back with $1,500. That's all good. That's the ensemble average. But let's say Jack goes to the casino and every day he uses the system to make 50% of his money. So he goes day one, puts down his $1,000, comes home with 1,500, goes back the next day, compounds at 50%, right? We get to day 27 and Jack has $56 million. Like, fantastic, right? You're on Zillow, you're on, you're looking at dream properties down in South Florida, Ken Griffin's going to be your neighbor. Everything's amazing, right? But then day 28 shows up and you blow up. Game over. You lose everything. There is no day 29 in the casino now. Like, you are totally blown up. And that's the difference between your path ensemble through time as we compound versus the ensemble of a group. And that's what we're missing a lot of times is, what does our individual path look like over time? And what are the sequencing of those returns, and how do we compound them? That's why it is so detrimental when we have these massive drawdowns of 50% in the stock market. You have to make 100% to get back to even. And people aren't thinking about that. And we can get into behavioral things where people capitulate then and they miss the run back up too. So there's a lot of other things involved when we think about our individual path versus what has been the average for hundreds of millions of people over the last 40, 50 years.
I think that's what people miss a lot in retirement when they think about sequence risk is it's great to have this thing where you multiply, the outcome by the percentage chance of the outcome. But the problem is when 20% of the time you have no money left, like, you can't use that standard framework. You got to think about, now I'm broke. Like, do I want a 20% chance that in retirement I'm completely broke? That's the problem, I think, when people think about stuff like this.
Yeah, I don't, we try to build a total portfolio solution, right, that helps you muddle along in any kind of macro environment. But I do not envy financial advisors because, like, right, you're dealing with retiree savings, right? And they need that savings to, like, outpace the rest of their life, and that glide path and all the metrics you're running in Monte Carlo simulators to make sure that they maintain their level of wealth on that glide path. That scares me to death. I wouldn't want to do that because, once again, you're using averages, right? And we're talking about individual paths. I think the most perfect example of that is our buddies at Resolve Asset Management wrote about this, years ago, about your sequencing risk, and talking about just using the Dow's index average. So from like 1966 to 1997, the Dow index averaged an 8% annual return. And you'll go, great, over that whole period, 8% average return. If I was thinking about my retirement, I'd be just fine. The problem was that those returns varied greatly over that 30-year time horizon, roughly 30 years, right? So from 1966 to 1982, there's essentially no returns. $1,000 invested in the Dow index from 1966 to 1982 returned $1,080 by 1982. So there's zero returns over the first 15 years. Then from 82 to 97, the Dow grew at 15% per year for those second 15 years. But then we hear a 30-year average of 8%. And this is what people aren't thinking about, especially in retirement when it comes to their savings. So if we think about like a couple that's going into retirement, and let's say they're high-powered lawyers, whatever, and they're reaching those mid-60s, they're 63 years old, they've accumulated $3 million in savings. Now it dramatically affects their portfolio glide path on whether they're able to live well off those returns, depending on the sequencing of those returns. And so, let's say the financial advisor comes in, they figure out the normal glide path of the average. They said, okay, great, we're going to have an 8% average return. Given your $3 million, your lifestyle needs over the next 30 years, we think it's safe for you to have a 6% withdrawal rate, and then we'll up that by 3% a year for inflation, right? And they go, great, let's run it. Well, the problem is if they got that return sequence similar to the Dow Jones average, where it was flat for those first 15 years, and they're taking those 6% withdrawals and then upping it by 3% a year, by year 13, they're broke. They're completely out of money. So it matters dramatically how those returns come. Whereas if you flipped it around and they had those second 15 years that were compounded at 15%, they would be much better off. And then vice versa, if we think about somebody that's, a young person that's 34, that's thinking about, okay, I'm going to save until I hit my retirements at, 63, 64 years old. And they want almost the flip side of that. Meanwhile, would they let's say they put down $100,000 into savings, they add, $1,000 a month into their savings, and they're looking for that to compound until their retirement. Well, if they have a large sequence of returns initially on that low capital base, that's not very good for them. That's not going to help their compounding. They want the large sequence of returns become their peak earning years and when they built up a larger capital base. And so we don't talk about that often because I can understand it's very difficult for financial advisors to explain that to their clients. But two, when we don't know what that future path looked like, it's very difficult to figure that out for the clients.
Yeah, it's funny. Like when we work with people like in their 20s, it's like you want to be like so excited. You're like, this bear market came. This is the greatest thing ever. This is so awesome for you and your future. And it's like people don't want to hear that though. Like when they put their first amount of money in the stock market, like their first hard-earned money, and they lose like half of that money, they hate it. But like it is true though. Like that's when you want, that's when you want the drawdowns when you're really young.
Yeah, I think Meb's talking about recently, like millennials or Gen Z or Gen Alpha, like cheering for for the stock market to go up is crazy. You want the stock market to have right now, like you want to, but that's not the case for people, right? They just like to see that up and to the right. And I think it's interesting. I think it's what is the last 5 years we've been at like 14-15% returns for the stock market. So now people are getting attenuated for that when they do surveys. They expect like 12-15% returns moving for the rest of their lives by just indexing or doing target date funds. And going back to like, pulling samples of that path, I think it's unique this last 40 years in America where you've had that 60-40 portfolios done so well and you had negative correlations between stocks and bonds when they can be highly correlated during the broader swath of history more often than not, the majority of the time, and especially during times of inflation. And that, we just had this kind of Goldilocks moment for the last 40 years. And I think a lot of people are attenuating their savings to this Goldilocks period. Now, I hope it runs on for their sake. But I don't know the future, and neither do they. So I just try to take a broader historical context.
So now that we've talked about the problem, I want to talk a little bit about how you think about solving it. So your approach, you think about the different quadrants of economic outcomes, and then you have your own 4 quadrants in terms of how you think about protecting against them. So can you talk about what that is?
Yeah, so the 4 quadrant model was popularized by Ray Dalio, but it was really come up with by Harry Brown in the early 1970s. And the idea of the 4 quadrant model is everything is on the axes of growth and inflation, right? Whether in growth or recession, inflation or deflation. And it's kind of like a Venn diagram. They can obviously overlap a little bit. But Harry Brown, talking in the 70s, is like he wanted his portfolio to do fine in any of those kind of global macro environments or any of those quadrants. So he used stocks for growth. He used cash for recessions. He used gold for inflation, and he used bonds for deflation. And he split them evenly. That was this kind of 4 quadrant model. Dalio kind of took that 4 quadrants, copied Harry Brown's work, didn't give him credit for it, but then kind of leveraged up the bond side and called it risk parity, right? And then we saw, as I was always worried about, risk parity in 2022, has a rough go at it when stocks and bonds become correlated. But like I said, over the long swath of history, the majority of the time stocks and bonds are correlated or more than 50% of the time, I should say. And so that's kind of the 4 quadrant model of thinking about global macro regimes and thinking about your portfolio in the past and in the future is like, how do you manage those? So we just view if Harry Brown were alive today, he would have more modern tools in his toolkit. And so for growth, we use global stocks instead of US stocks for stuff we've talked about. But in fairness, using global stocks for the last 10, 20 years has been more of a detriment than it has been accretive to our portfolio, but we still view that broad diversification is a better way to go. For a recessionary environment, instead of cash, we use long volatility and tail risk. And I probably talked about this a lot on our last podcast, is the idea there is you have a much more convex like cash position. The way I look at it is like if the market, sells off, you have, those deterministic put options explode in value. And now you have, instead of, harboring a bunch of cash on your books, you can use a much lower premium, almost like insurance, where you're spending 2 to 3% a year on insurance premium against the market, and then explodes in value to really protect you against those drawdowns. But more importantly, to rebalance into those drawdowns, which you'll hopefully get to. And then for the inflationary environment, we use commodity trend following instead of gold. I think gold's great. I'm not sure exactly what gold is. People love to debate that, but it's got a, some would say 6,000 year history. And it tends to protect your purchase power parity over the very long term, but maybe not in the cute short term. So we think commodity trend following, trading those 60 markets that you can get in managed futures, both long and short across, energies, metals, softs, agricultural, meats, et cetera, tends to have a higher beta to inflation. So we like that better for an inflationary environment. And then for a deflationary environment, that's where we use global bonds and other income-like sources, because in a deflationary environment, you want more of a fixed deterministic income flow than anything else in a deflationary environment.
Yeah, gold seems to be one of those things that works 100% of the time, 75% of the time, or something. Like in
Exactly.
22 was a good example. Like people who had gold expected it to be more of an inflation hedge in 22 than it actually was.
Yeah, it's hard. Like if you look, you always see it quoted probably that like it's the equivalent of like a bespoke suit or something, right? Like a suit of armor costs the same amount of ounces of gold as like a Savile Row bespoke suit now does. So it's like it maintains your purchase power over like centuries, But in any given year, quarter, or decade, it's probably not going to, right? It's going to disappoint you.
And I'm wondering on the long volatility, like for your average investor who, doesn't invest in hedge funds, that's probably the hardest thing, right? Because long volatility is very hard to do without having that bleed, the money you're losing when you're not getting those volatility at events like that and tail risk. You think that's the hardest one for your individual investor to do?
Yeah, it's definitely the hardest one. That's the one we started with because we debated for a long time if we started with our full total portfolio solution with the cockroach fund, or we just started with that sleeve of long volatility. And we originally started with the sleeve of long volatility because I just got tired of friends and family read Nassim Taleb, Mark Signal, or a lot of more modern people about managing your tail risk or black swans, and they go, great, how do I do this? And I said, do you have over $100 million? And they're like, no. Well, none of these firms will talk to you, so good luck to you. So we figured we're, better probably entrepreneurs than traders. So we figured there had to be a solution for that. So now we're invested with 14 long volatility and tail risk managers across our ensemble. And we allow retail accredited clients to get access to like those portfolios that they normally would never have access to. And the reason we use that ensemble approach is because there's a lot of path dependencies to a sell-off. And I think a lot of retail clients maybe don't realize is they think that, hedge funds are really just trying to get like a total return in any environment and really just do well. But it's not how it works because the institutional clients want them to do, the allocators want them to do very niche strategies. So when we look across the long volatility tail risk landscape, there's maybe 30, 35 managers that we track, which is the entire space, and we allocate to like 14 of them. And the idea is there's a lot of different paths to a sell-off and a lot of different paths of moneyness and volatility. And you want to be trading whether it's the VIX markets, the options markets, the managed futures indices. There's a lot of different paths to the way sell-off can manifest. And we want to make sure we capture at least the meat of that move through an ensemble approach. Because I think what's happened historically is 2020 happens or 2022 happens and people chose what they thought was going to be the best manager for long volatility or tail risk. And maybe they didn't perform or they didn't monetize it perfectly. And then people are really disappointed with that asset class where I'm like, I'm just trying to get like a beta-like return by having a broad ensemble of that asset class. Because I think if you heard anything from me in this podcast, I'm pretty agnostic and I'm not high on my own predictive crystal ball powers. So I try to, diversify as much as I broadly can to get much more of a beta-like signal and not rely on luck to help out my portfolio.
We won't be seeing you release your macro letter anytime soon, I guess.
Never. If you do, man, I should think what we should do if I ever do. Like that's a great April Fool's joke for me though. Actually, like that's
You should do that.
I can't believe,
you should do that on Twitter. That'd be great.
Yeah.
It's always compliance is always an issue with those kind of things, but nonetheless.
Oh yeah.
Yeah.
Well, I mean,
think
it's shocking.
No, yeah, but so this is a good lead into this idea of fractal diversification that you've talked about. I would think like in the volatility space, like in the tail risk space, that might be where it's most important. Is this idea that you have to be diversifying inside of the diversifying in order to get the right stuff, that works in all the different possible outcomes.
Yeah. So fractal diversification is this is a shout out to Benoit Mandelbrot that came up with fractal geometry. And the idea before was like geometry was really Euclidean, is all about smooth surfaces. And Benoit Mandelbrot was, as most geniuses are, the one that points out the obvious that's never really been spoken before. And what he was pointing out is like nature has a lot of self-similarity to it. Like if I look at the tree outside my house, but then I kind of frame into a branch, the branch has a self-similarity. It looks like a mini tree. And if I then zoom into a leaf, it has a self-similarity where it almost looks like a mini tree in the leaf. And so he's showing like there's very rough surfaces to nature, but they have this fractal nature to it of self-similarity as you go up and down the scale. Like, especially if you look at like coastlines, from very high up, from 30,000 feet, it looks like a jagged coastline. You get in closer, it looks more jagged. You get down to the granular sand level, there's jagged nature to that in the rocks. And so that's the idea of kind of Benoit Mandelbrot's like fractal geometry. The way we think about it with our portfolio construction is that we start out as a very high level is like, we like to combine offense plus defense. As I said, defense wins investing championships. Most people's portfolios are 99 to 100% in offense. So we're very unique where 50% of our portfolio we view is in defensive assets. So we start at a high level, offense plus defense. We think about correlations in broad terms. So like when you have conditional correlations and liquidity events, we'd like to have strategies that are correlated to GDP or liquidity, uncorrelated and negatively correlated. Then below that, we had the 4-quadrant model that we discussed. But then within the quadrants of the 4-quadrant model, we'd like to broadly diversify there. And like we were saying, 14 different managers and long volatility tail risk. But even within those managers, a lot of them have like maybe 5 strategies within volatility. And then they have different ways of trading those strategies in different instruments. So we start, with one allocation to, let's say, our cockroach fund, where on any given day, we can have 2,000 to 2,500 positions on, underlying that on both the offensive and defensive side.
How do you think about when you're thinking about adding something to this? Because this is obviously a very, very diversified thing. How do you think about a framework in terms of whether it adds value? And I guess this would work on an asset class level or on a manager level. Like I saw you have some crypto in there, so you obviously had to go through this when crypto came on the scene. Like thinking about, does this add value to our already diversified approach? Like, how do you think about that?
Yeah, so there's so many things in there to unpack. When we talked about the four quadrant model, I kind of talked about the way we look at it, but we also have what we hold 20% in what we call fiat hedges because we don't necessarily want to get in that argument too much. But in the fiat hedges, it's 16% gold, 6% of which is physical gold in vaults, in segregated vaults, and then 4% is crypto and it's market cap weighted. So it's about 2.5% Bitcoin, 1.5% Ethereum using the futures because we did this long before the ETFs and the spot ETFs kind of came online. And the idea there was, that broad diversification is fiat hedges, like things happen like wars, diasporas, markets shut down, all those sorts of things. And that's why we're looking for those fiat hedges of gold and cryptocurrencies. Now, we can argue all day long about, is gold a proper fiat hedge? I mean, historically, yes. What would be the exponential return of that? What's your multiple? I don't know. But like, I think at 16% gold, we're pretty good, especially 6% physical if even the liquid market shut down. And then the idea with the cryptocurrency position, especially in Bitcoin, is like, what if the Bitcoin maxis are right? What if that is the new gold? What if, we do have a true fiat devaluation and Bitcoin goes up 50x? Well, a 2% position is pretty, solid there. And we're just trying to be agnostic and really have that, humility to know that we don't know what the future holds and some people might be right. But in the meantime, what's great about even, having that position in Bitcoin or other cryptocurrencies, et cetera, is we can harness the volatility there. We can use rebalancing on a monthly basis to harness that volatility and hopefully get a rebalancing premium out of it. So it's not like a one thing, one's kind of solution. So that's broadly how we think about even like gold and cryptos in there. But like going back to your question about even on the volatility space, is if you think about the sell-offs, and you do a phenomenal podcast with Brent at Spot Gamma that I absolutely love. I mean, it's probably me and 5 other people actually watching it though and getting.
I think it is, yeah.
As
Pretty much, but
it's
the
very
5 people really love it. The 5 people that watch it are like huge fans, though.
Yeah. Yeah, it's that. Yeah, people, that's how I try to woo women at the bars, talking about market maker gamma positioning. It's really exciting stuff. But I love that kind of stuff. But the idea, though, in long volatility and tail risk space is like, we first try to cover the paths of moneyness, right? You have to decide, like, if you're kind of, covering from close to at the money to out of the money, deep out of the money. And we want to overlay and overlap those paths of moneyness. And if you use active long volatility traders that are actively trading options, what they're trying to do is less that premium bleed you're talking about of paying that almost insurance premium, like you have with house insurance, car insurance, life insurance. And so what they do is they might trade in on the markets that are looking like a forest fire, right? They're looking for wind conditions. They're looking for humidity levels. Is there lightning strikes? Then they might jump into markets. But by having that active participation on the long optionality side for those different paths of moneyness, they might miss the timing of the market. So we like to overlay the deterministically permanently on tail risk positions. Like if you have something over the weekend happen, like in the Nikkei, like you want those positions on in case the other managers aren't in there. And then we use things like relative value volatility with a lot of different trading styles in there too, to help, maybe pay for a little bit of that premium bleed. And then, what happens when markets expand in 2020 and the implied volatility, your options makes it prohibitively expensive to roll those positions and you monetize them. What do you do? And so the second leg down, we love things like shorting the managed future stock indices around the world on an intraday basis. So like it's really thinking about all the things that can and will go wrong and finding niche managers that do very specific things. But at the same time, like I said, I don't necessarily look for them to deliver alpha. I'm trying to roll them up in an ensemble approach where I can get more of a beta-like return signal from the entire environment.
Yeah, when I want to explain the rebalancing premium, I always use tail risk as my example because you could have a tail risk strategy, and people hate this example, but you can have a tail risk strategy that has a 0% long-term return. And if you rebalance that strategy at the right time, it is going to add to the return of your portfolio in many cases, despite having a 0% return. And people don't get that, but that is the benefit of a strategy like that.
That's the hardest part, I think, I've found is like people either read like Taleb or whatever, and they get that or they don't. And I find if people don't get that, I don't try to argue with them anymore or try to like, just like everything in life, you can't really win people over to your side of way of thinking. It's like they either get it or they don't. The other prime example I use is like, you can't have coastal real estate without, home insurance, right? You can't have a $20 to $50 million house on the coast of Florida or South Carolina without home insurance. Like you could self-insure. But like, do you have 20 to 50 million cash in the bank when that does happen to rebuild your house, or else it's game over? And it's interesting that we either like, we have house insurance, we have health insurance, we have, life insurance and car insurance, but all of it is going back to sequencing risk because we don't know when that emergency event is going to happen. And we need that convex cash position that insurance provides, assuming it pays out, obviously. And that's what, if you don't have portfolio insurance, as Taleb said, you don't have a portfolio. But then, like you said, I find it's really hard if people don't get that, or why you would want to return a zero or negative returning asset to a portfolio. Then it's hard to convince people. But then I think we're also able to use what we call, implicit leverage or capital efficiency that we use in options and futures markets, where we can give them, a spoonful of medicine with the full allocation to their long beta and kind of overlay that tail risk. So it makes it a little bit, hopefully more palatable at the total portfolio level.
I want to talk about withdrawal rates because in the space we operate in, and I talk to a lot of financial planners. They have big Bill Bengen's work around the 4% rule, and it would seem to me, I don't know if people have done a ton of work like around this, but it would seem to me like these total return type of portfolios that are more, that can handle various economic scenarios would likely support higher withdrawal rates than a stock and bond portfolio. Have you looked into that at all, or do you have any thoughts on that?
Yeah, so I think it goes back to like the example I gave that Resolved used for the retirement couple and using the Dow index from 66 for the next 30 years. Is it really depends on the sequencing of those returns along our individual path. So a lot of people think about their investing in expected value, but we think about expected path. And what I love about things like what we do with these total portfolio solutions that are broadly diversified is they're very boring, right? If we go back to those 4 macro quadrants, is like you want to make sure you kind of chug along with any of those macro environments. Like 2022 was phenomenal for like commodity trend following in like that environment. Like, so if you think about the defensive side, is like long volatility and tail risk is great for liquidity events, like those really acute ones, like March of 2020, or like what a little bit of what we saw in October of 2008. They do really well to that. You have that convex cash position for that rebalancing effect to then buy your stocks and bonds at a lower NAV point. But if you have a more protracted recession or inflationary period, the CTA's commodity trend followers tend to do a lot better in those environments. So it's kind of a 1-2 punch on your defensive side. And that's why we like rebalancing with those. But what I'm getting at, the more important thing on the 4-quadrant model is like whether we have growth or recession, inflation or deflation, that portfolio is going to do pretty good. It's going to muddle along just fine. The problem is it's going to trail, just a pure S&P 500 portfolio of any given quarter or year, or even 60-40 from time to time. And so if people are thinking about keeping up with the Joneses, it's really hard behaviorally to be part of these portfolios. And I say that, so like example, Meb does these great things on portfolios too, of like, broad portfolio diversification, whether you go with permanent portfolio, risk parity, IV, et cetera, they tend to muddle along in kind of any environment. They all come around the same, level of returns. But if you did an unlevered permanent portfolio over like the last 40 years, I think like your real returns are about 6%, which is, I think is fantastic. If the inflation rate's 3%, and your real is 6%, and you can count on it, like any decade has actually positive real returns, that's a phenomenal portfolio to me. But it's less than people expect from like a stocks or a stocks bond portfolio. So the way we think about it is we use some of that implicit leverage to kind of lever that up 2 to 1. So that gives you an idea of those portfolios. And I say all that because then, like you said, if the quoted rate is you should think about a 4%, withdrawal rate. If you have a broadly diversified portfolio that you expect to have like, let's say a 10 to 12% return rate, that makes a lot more sense on that 4% level. And then you start, subtracting inflation, et cetera. Whereas as we go with the sequencing risk, if you have just stocks or just stocks and bonds, I'm really worried about the sequencing risk, where with a broadly diversified total portfolio solution, you can really reduce the variance of that portfolio. So you can much more rely on those kind of return profiles on any given year, any given decade. And that to me makes it much more likely to be able to hit those targets on your withdrawal rate if it's 4%. But there's not a lot of great work being done. And then the hard part, like, once again, it's still sequencing risk. So like, I'm not sure, like, I would really stamp it with a guarantee that you should be able to do this. But like, if you look at the kind of broad arc of history, and even those times when stocks and bonds are down, hopefully your commodity trend's going to do well, or your long volatility and tail risk, put some cash on there, or maybe your fiat hedges are doing well. But yeah, that's the idea, is like, to me, it gives you the best shot of hitting like a 3-4% return rate with inflation. But I wouldn't guarantee it. I don't think there is any guarantees in life.
And I think people miss like max drawdown. When you're thinking about sequence risk, max drawdown is a really important stat. And that's where these permanent portfolio type things are better than stocks and bonds. They have significantly lower max drawdowns, which limits the sequence risk in your portfolio.
Yeah, it's not just sequencing risk, it's behavioral risk, right? Like, I'm sure you saw this as well. Is like 2008 happens, right? You hit a 50% drawdown plus, and that's when people tend to really capitulate. So you had a lot of people that just said, that's it, I'm going to cash. Like, their financial advisor had them in there. They said stocks for the long runs or 60-40 for the long run. It drew down 20%, 30%. They were okay. But when it hit like 50% drawdown, they capitulated and they said, that's it. They fired their financial advisor. They just went purely to cash. And then they were so gun shy, they missed the rebound from in 2009, 10, 11, 12. And so that behavioral effect hurts people's compounding more than anything else. So it's not necessarily those unrealized drawdowns and gains, is that we realize them in a behavioral level. And I think Jason Zweig said it best, is like, I can draw you a picture of a snake, but until I throw a snake in your lap, you're going to respond very differently. And I get a lot of like younger guys that are always telling me, if the market's down 50%, I'm a buyer. And I'm like, we'll see.
Yeah, exactly. You can never understand what it's actually like to be sitting there. I mean, I was managing money in 2008. It was ugly out there. Nobody was looking to buy
it
anything.
seemed
Yeah, what's also interesting to me on the 4% rule is like, we had Wade Pfau on the podcast who looked at Bengen's work, but applied it to other countries, going back to what we talked about at the beginning. Like the 4% rule does not hold up in the majority of these countries. Like it did work in the US, but when you start going to these other countries, it doesn't work as well. So if we think about like our future in the US might be maybe not like our past, but it might be more like the average of what these other countries are. The 4% rule might be a little weaker, with a stock and bond portfolio, at least, than people think.
Yeah, I think, like we're saying, like, I think we attenuate our portfolios too strongly to recency bias. Like, we look at what 60/40 portfolio has done for the last 40 years, and we expect it to do the same over the next 40 years. And I think that's pretty illogical. If you think, you know, baby boomers were really the luckiest generation in world history on a financial basis, with, rates coming down and their actual financial assets, especially leverage real estate, skyrocketing. Is that going to happen for the next 40 years? I mean, I hope it does for everybody involved, but I just think it's unlikely. So yeah, it's hard. Like, yeah, where does this 4% return come from? It's because you're looking at an unusual period that you think that would have worked for. Like, and so we're attenuating the rear view mirror. And I always think about, it's like Soren Kierkegaard is like, the real problem with finance is we are trying to learn everything we can through the rear view window, and yet we have to drive forward looking through the windshield. And unfortunately, those two a lot of times don't line up. But that's how we're, unfortunately, from an insecure basis, we're trying to understand the world by looking at the past. But unfortunately, in markets, as we said, it's a non-ergodic system. And then we have a non-stationary of data issue, meaning like, this is not like a casino game. The past is not going to predict the future with perfect accuracy. More so likely, we have shifts in regime, and the future is going to be very different from the past.
How do you think about leverage with this? Because on one hand, this would be these types of total return portfolios that look at all the quadrants. They'd be perfect portfolios to leverage, because it's an example where you can add leverage without adding too much risk to the portfolio. But on the other hand, we talked about the idea that the past could be very different, or the future could be very different than the past. So obviously you don't want to go crazy with that, thinking that something might happen that didn't happen in the past. So like when you think about levering this type of thing up, how do you think about the pros and cons of that?
Yeah, so going back to the idea of offense and defense and having an equal measure, another way to say offense is short volatility assets, and another way to think of defense is long volatility assets. And pretty much every blow up we've seen from trades or hedge funds is when they lever up short volatility trades. So it's very different to me when you pair short volatility with long volatility trades, or more importantly, you pair linear short volatility trades like stocks and bonds with convex long volatility trades like tail risk. And so if you think about the portfolio level, I also brought up the idea is like correlations are conditional. And I think that's what can get people in trouble, especially in like risk parity world, is they are attenuating the leverage in their portfolio based on a data set of past correlations. And whatever that window is whatever they use moving forward to attenuate the size of the portfolio. And I think that's very dangerous and risky because, like I said, there's non-stationary data problems. So if you're looking at, 3 years window, 5 years, 20 years, 40 years window, there can be a regime shift and the future doesn't look like the past. And now you've over-levered portions of your portfolio based on past correlations. So we try not to weigh on past correlations. And I think that was the brilliance of Harry Brown's permanent portfolio. It was equal weight in those four quadrants. And so we think about equal weighting those four quadrants, and then we use the implicit leverage we can get, the capital efficiency in managed futures and options, to then take those from 25% each to 50% each. Now, like you said, you are probably increasing variability or the unknowns when you use leverage. But I think when you're using a truly broadly diversified portfolio of offensive and defensive assets and pairing those up together, you're much safer than using leverage than what people typically think of it. Using levering up like a short volatility trade is what usually blows people up. And so that's what gives us that confidence in that approach. And then assuming like, Kelly criterion, right? Like if you could actually use that in markets versus gambling games, which I don't think you can. I have plenty of friends that will argue you can, but I'm not sure it's certain. It's like looking at past windows, you could probably lever up a broadly diversified portfolio, like the ones we've been talking about, like anywhere from 8 to 10x. So, but people, use, some humility to use half Kelly, that's 4 to 5x. And if we're using like 2x leverage, I'm less than a quarter Kelly. So I'm pretty, I think it's a robust way of looking at the portfolio.
Yeah, people, no matter how much you talk about leverage, people always tend to have this, problem associated
Yeah.
with it. They always think like when you're adding leverage, you're at, no matter what you're adding along with it in terms of diversifying asset classes, it's always making the portfolio riskier. And that's something I try to talk to people a lot about is like it depends on what you're levering up and what you're adding to your portfolio with the leverage, in terms of what the leverage actually means to the total risk of the portfolio.
Well, so it's crazy because like there's a couple examples of that. It's like 60-40 portfolio. It's wild to me. I don't, everybody's trying to dig out where did 60-40 actually come from, and nobody's really certain. But if you actually look at like, as you know, that 60% in stocks means like 90% of your portfolio variance and volatility is in stocks. So that's where all your risk is. So historically, you should actually only be running like 35 to 40% in stocks. So it really should be a 40-60 portfolio. But we don't think about that way. And that's essentially leverage, right? Like those individual equities are essentially giving you leverage in a way. But if you look at like Spitzenengel's work and at Universa with like Nassim Taleb, is like they're talking about like if you're 100% long S&P beta, but you spend 2 to 3% a year on that insurance, people would say, well, now I'm more leverage long, but like that insurance is offsetting a lot of that product, right? So like the question is now, am I 2x leverage or am I market neutral? And that's the debatable thing is like, how close are you to market neutral, even though you may be using leverage? So you actually may be much safer by using prudent leverage, but it really is based on your portfolio construction and what happens to conditional correlations.
So we've always had a standard closing question, which is if you could teach one lesson to the average investor, what would it be? But I just put up a mashup of that the other day, and there were 119 answers in it. And so I've decided I need
Wow.
a new closing question because we've asked basically anybody we can think of the closing question. So and you've already answered this, and you were in the mashup. So I'm not going to ask you that. But I thought to come up with a new one. I thought I'd test it out here, and I thought I'd steal this from Meb Faber. And Meb, if you're listening, I apologize if you didn't want me to steal this. But we just had Meb on a podcast where we talked about this idea of things he believes that the majority of his peers would disagree with. And I think you're a perfect person to ask this because I think there's a lot of things you believe that the majority of your peers would disagree with. So if you could come up with one thing that you believe, do you think the majority of your peers would disagree with about investing? What would it be?
Wow. You know what just hit me? I think why I sound different is if we just use the word believe. And that's what I think the problem is. I think in our industry, people believe a lot of things that aren't true. And it's based on like insecurity, right? Like we're so desperate to manage our clients' wealth that we're looking at these historical representations and drawing inferences of them. And then that provides a belief system that then we think's true. So I think about like things, there's so many things I don't even know how to pick. One is like, I don't believe alpha exists over the long term. I believe you combine interesting betas, obviously. I'm actually with Meb too. Like I think the Fed does a decent job. I don't know anybody else I think that argues like the Fed's doing a terrible job. I know two things. One, if they're a hedge fund manager, it means their P&L's down. And I'm like, you could trade with whichever direction you think they're going, even if you think they're wrong. And then I also think rates don't matter. It's just a hurdle rate, and everybody like entrepreneurs are going to be entrepreneurs no matter what the rates are. They can't help themselves. Trying to give you a broad sample, but what it boils down to is essentially, I think it's really difficult what we do. And I think that if we're truly honest, nobody knows the future. Nobody has a crystal ball. And so I just think if I can hold most of the world's asset classes and rebalance, I should muddle along okay. And that's what I think the biggest lack of belief. I think it's more of a lack of belief that I have versus I'm always shocked by the things that people say in our industry because I'm like, how do you believe that? How are you determining that? What's the base truth in what you're saying? And if you I feel like I'm a 6-year-old sometimes at some of these conferences. If you ask why 3 times, they tend to fall apart. And it's very interesting that, the emperor has no clothes. And, it's a really weird thing that like, the ultra wealthy and the aged just love to think they have a crystal ball to predict the future. And it's always kind of shocking to me. And I just find myself out of kilter in that way. I don't know if that answered your question in a way that's
It
viable,
did.
but
Yeah. I was thinking as a podcast technique, I should try this ask why 3 times. I should just keep asking why to somebody and see
don't
where it goes.
No, you can't because it's a weird thing too with podcasting, right? That like we're fairly amenable as podcasters, right? Like I'm sure you're when I'm on the other side like you are, you're just everybody wants you to debate them, but that's not the point. You're supposed to help draw the questions out of the person, and you're just supposed to be like there as a guide or a Sherpa. And so it's if you ask why 3 times, your guests are never going to come back because they don't
No,
want
that's
that
true.
combative nature.
Actually, it's funny because I was talking about somebody about this recently, and like the criticism of us is like, well, you're not digging in and challenging all this person's beliefs. And I'm like, that's not what this is for. This is for us taking somebody who knows a lot about a certain topic and imparting that knowledge to our audience. Like that's the goal. And if I sit here and challenge them the entire time, it's not going to accomplish that goal. And plus, like you said, I mean, the podcast is going to be me talking to myself at a certain point because there's going to be no one left who wants to come on. Right.
Yeah, that's why I love what you guys do, and a lot of our friends that we brought up that have podcasts. I love it because it reminds me of my favorite books coming up were the Market Wizards books, right? And what you learn from that is a lot of people have very different viewpoints, and a lot of people can make money over the long term in the markets. But what you find is they have very different styles and beliefs. And so you just need to find the one that works for you to hold over the long run. I mean, that's really what Buffett's done. And there's just nobody in history for 6 or 7 decades that is stuck with one style, pretty much. And that's what it's about. And so, like, when you have people come on, you want them to show you how they think, and then the audience can argue with them internally or publicly, or figure out what works for them and what doesn't work for them. That's definitely not your job, or else, like you said, you'd be out of a podcast soon.
So, but anyway, I want to have you, we didn't get to all of Mev's ideas that he disagrees with most people on. So I think we need to have you and Mev together next time, because you have a lot that you got in there. So maybe we need to have both of you on next time, and we'll challenge some conventional investing beliefs.
Yeah, maybe for Mev, it's Southern California is a short volatility trade, and he's out of his mind. But I can't help it. It is a beautiful place most of the time.
Thank you so much for doing this. This is awesome. I really appreciate your time. If people want to find out more about you or Mutiny Fund, where can they go?
Yeah, you can find us at mutinyfund.com. That's singular. And then on Twitter X, I'm at Jason C. Buck. And that's the best way to find us. And then, like, a lot of the papers we talked about, or a lot of the concepts, we write a lot of that in our insights on mutinyfund.com. And we actually just put out an 80+ page white paper for free that really delves into all of our philosophy around cockroach strategies and the way we think about portfolio construction. And I think I applaud you for having me on too, especially because, and you guys talk about this often on your podcast, I think portfolio construction is the least talked about thing in finance and investing, and it's the most important thing. And so until we get that right first, none of the individual, strategies, asset classes, or individual trades actually matter unless you have an overarching portfolio philosophy.
Yeah, and I would definitely recommend your website as well. You've got a great blog there. A lot of the topics we talked about today are on there. You've got the Mutiny podcast, which is great as well. So I'd recommend people check all that out. Thank you, Jason. I appreciate it.
Thanks, Jack.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.